听点资本本期视频为您带来的是摩根士丹利在美国时间4月2日闭门会关于最新对等关税政策动态的观点。最近经济是不是感觉有点看不懂？关税政策悬而未决，这不光影响物价，推高通胀，还可能拖慢经济增长，影响企业招聘决策。移民政策也在变，这对未来的劳动力市场可能是个大问题。尤其在婴儿潮一代退休的背景下，劳动力短缺风险加大，反过来又限制经济。政府这边号称削减开支提高效率，但对庞大赤字影响有限，真正的削减可能波及医疗补助等领域，影响深远。经济数据看着有点软，消费者信心在降，企业投资更谨慎了。虽然现在还没到衰退的地步，但增长放缓是大概率事件，美联储也只能先按兵不动。这种环境下，投资市场也变天了。之前大涨的美国科技股回调，反倒是国际市场和债券表现亮眼，这警示我们过度集中的风险很大。你的投资组合可能急需重新审视，多元化从未如此重要。接下来的内容就深入剖析了这些风险点，以及他们对经济和你的投资策略到底意味着什么。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Business planning and investment spending decisions. So I think it is slowing economic growth. And I think it's probably also having an impact on hiring. And I think it will push up inflation. And I think you'll see somewhat higher inflation over the course of this year. But so long as you have a one-time adjustment to tariffs, to tariff rates, and then we don't change them again, move them higher again in 2026, it's an increase in inflation for 1 year, an increase in the price level, which sticks, but the inflation rate itself should come back down again. One other thing that I think is should be a silver lining here is that I do think that the administration and Congress are going to have to decide on this, or the administration is really running tariff policy here, but they're going to have to decide on it because this is something that the administration sees as a funding source for their big tax bill, and they're going to need some funding for significant tax cuts. I do think that the greater the economic damage, the more tax cuts we'll see. I'll get to that in a second. But overall, at some stage, you're going to have to put in, not in pencil, but in pen, how much revenue you expect to raise in tariffs as an offset to tax cuts elsewhere. So that's one issue. If we move to the next page, I wanted to talk, this is page 26 of the guide. I want to talk about another big issue this year, which is immigration. Now, what we've seen so far, I think the data are still not there except in one area. But we have seen three things happen. One, we've seen a significant, a really historic decline in people coming over the southern border. That was running at 250,000 per month in the fourth quarter of 2023. It fell to 100,000 per month in the fourth quarter of 2024. The numbers we have for February were down to 12,000. I suspect it was even lower than that in March. But essentially, the southern border, people just stopped coming over the southern border and claiming asylum. And so we've seen a huge decline in unauthorized immigration. We've also seen some mass deportations. Obviously, a lot of these deportations are getting a lot of publicity in terms of how they're being conducted and who's being rounded up and for what reason. But the actual number of deportations isn't significantly higher than it was under the Biden administration. Right now, they're still running at less than 1,000 a day, about 600 a day, as far as we can see from the latest data. That's from, there's an organization in the University of Syracuse, actually, or Syracuse University, called TRAC, which tracks a lot of immigration data. And they say that based on what they're seeing, the number of arrests for deportation really have not changed significantly from the last administration. So we're still running at about 250,000 per year. It's significant, but it's not noticeably different from last year. The biggest thing that and I think that's going to have, I think the administration is going to have a hard time pushing that number up, both because the more you go from people who are actually criminals or have a criminal record to the broader base of people who are unauthorized immigrants, the more you impact the ordinary operations of small businesses in America, or indeed the operations of households in America, where a lot of unauthorized immigrants are working right now. And I think the administration may shy away from being too aggressive in that. We'll see. The one other thing, though, I think we don't have a good handle on is how much are they slowing traditional immigration. So we know we've got data for immigrant visas through January, but we don't have data since then. in another month or two, we'll have a sense of this. But I do want to emphasize that there may be a problem at the end of all this. We've had huge immigration in the last few years, and that gives us a certain backlog to work through. But going forward, if traditional immigration falls to, say, 500,000 per year coming in through, getting visas in foreign embassies, and you deport about 250,000 per year, that gives you a net 250,000 addition. And if you then have no unauthorized immigration coming in through the southern border, suddenly you're at, immigration numbers, which back in the last decade, indeed the decade before that, were running at about 1 million a year. Suddenly you're down to 250,000. And I would emphasize that right now, because of the retirement of the baby boom, if you had zero immigration, the population aged 18 to 64 will fall by about 800,000 per year. And so you could run into a labor supply crunch. And I think you will see some labor supply crunch, which will tend to slow the economy because it's, immigrants buy stuff like anybody else. But there are also there are cases where, yes, you'd want to get going on a construction project, but honestly, you don't have the laborers to do it, or open a restaurant, or staff a retail establishment. So that could have a drag effect on growth also. But at the moment, I wouldn't say it's any greater than we thought coming into this year. And if you turn to page 23 of the guide, the next page, I want to talk about two things: cuts by the Department of Government Efficiency, and also where the overall fiscal situation is. So we've seen, again, a lot of headlines in terms of cutbacks in various departments and agencies from the Department of Government Efficiency, people being offered buyouts, people getting fired, plans to fire other people. I think it's important, though, to keep this in context, both in terms of the overall economy and in terms of the budget. So in terms of the overall economy, there are 3 million civilian federal workers, if you include postal workers. And it looks to me, based on what I'm seeing, but also a count that actually the New York Times is keeping up all the announcements, that the overall reduction headcount seems to be closing in on between 250,000, 300,000. And I think over the course of this year, that might be where we end up. So go from 3 million at the start of the year to 2.7 million at the end of the year. Now, first of all, in terms of the budget, if you look at the left-hand side of this page here, we show that for the federal fiscal year goes from October 1 to September 30th. So for this fiscal year, the Congressional Budget Office is expecting a $1.9 trillion budget deficit. If you get rid of 300,000 federal employees, then you will take, obviously, their compensation out of the budget going forward. But they earn about $100,000 per person. So if you reduce it by 300,000, you're going to save about $30 billion out of 1.9 trillion. So it's not, while these cutbacks, and I think efficiency is important, how you do it is also, I think, very important. But more efficiency is good. But let's not pretend that actually has any significant impact on total government spending, or on the deficit. And that's important because it means that if you want to cut back government spending in other areas, such as the $2 trillion in cuts that the House of Representatives talked about over the course of the next 10 years, you're going to have to do other things. One of the big areas I think will be in Medicaid funding and in more generally in transfers to the states. So you can have a knock-on effect. You're also seeing some reduction in loans or in grants, some delay in grants. I think that's having a chilling effect on anybody whose funding depends to some extent on the federal government. So there is a chilling effect from this. But again, in terms of the overall economy, it's significant. But we create 150,000 jobs per month. You lose 300,000 jobs. It's 2 months' worth. It's not nothing, but it's not enough to sink the economy on its own. But if you have a drag in the economy because of tariffs, and a drag in the economy because of less immigration, and a drag in the economy because of cutbacks to the federal government, all that does slow the economy down. But at the moment, and I'll get to this in a second, I don't think it's quite enough to put us in recession. But the weaker the economy gets, the more likely it is we're going to see fiscal stimulus in 2026, and possibly even before then. Now, I write an article, as many of you know, on LinkedIn, or it's posted on LinkedIn every week, and it comes out on a podcast called Notes of the Week Ahead on Apple Play and Spotify. And I wrote something recently called Fiscal Fudge. And it's really about ways that you can actually stimulate the economy while ostensibly saying you're trying to reduce the budget deficit over time. You could fund 5 years of tax cuts with 10 years of spending cuts. You could say the baseline isn't what will happen under current law, but what the baseline is under current policy, so all the tax cuts just automatically get extended. You could use what some people call the Dodge dividend, or the Doge dividend, where you take all the savings over 10 years, maybe it's $2 billion of savings or $2 trillion of savings, if that's what they say, may take 20% of that, $400 billion, but you give it out in a check at the start. I regard all of those as fiscal fudge because they're not going to reduce the deficit long term. But they could stimulate the economy. And I do think the weaker the economy is this year because of tariffs and Doge cuts and immigration, the more likely it is that this bill going through Congress right now gets juiced up with stimulus. And the real acid test for this will be what is the actual CBO projection of deficits for fiscal 2026 and fiscal 2027 when all is said and done. But I do think it's quite possible you're going to get some stimulus going into next year. All right, well, I'm sure we'll get questions and all that, but let me move forward to the economy itself. And I want to turn to page 32 of the guide, which is a new page we put in on soft data. We know we're at an interesting inflection point from a cyclical perspective. Is it going to weaken the economy into recession, or is the economy going to get through this? One of the ways we look at this is by looking at survey data, which sometimes people call soft data, which comes earlier than the hard data. And right now, it's, again, real time. This is why we like to update the guide on a daily basis. We've got the ISM manufacturing numbers up in the top left, and it was pretty weak yesterday. Services numbers are still looking strong, but we're going to see a number on that tomorrow. At the moment, there's no real evidence that it's going to collapse. If you look at business confidence, we have seen some backing off on business confidence from CEOs. We're going to see what the small businesses are saying in the next week or so. But I do think that this is somewhat lacking reality. I think that you'll see these survey data turn more negative. We've already seen, down in the bottom left, a significant drop in consumer confidence and consumer sentiment. And that, I think, reflects the flow of news, particularly about the Doge cuts and the tariffs, which I think is hurting confidence. And then home builders are getting more worried about, finding home buyers, but also just the cost of building, the availability of labor. And similarly, we've seen a drop-off in CapEx intention. So there's nothing on this page right now which is ringing, alarm bells, five-alarm fire. That's not on this page, but we are seeing some weakness. And if we turn to page 18 of the guide, I think a way of summarizing this weakness is, if we turn to the next page here, a way of summarizing this, whoever's in charge of the slides, can we move forward, please? So a way of summarizing this is looking at real GDP growth. So on page 18 of the guide, we show GDP growth through the fourth quarter of last year, 2.4% growth in the fourth quarter, looking fine. And overall, the big thing here is consumer spending was very strong, contributing 2.7 percentage points to growth. So actually, the rest of the economy net was in decline in the fourth quarter. We've just completed the first quarter. I will tell you that our tracking models are now finally giving us a slight positive. And the reason for that is that light vehicle sales shot up in March ahead of the tariffs. And so now they're whittled away at inventories, but we've seen a big spike in vehicle sales. We went from 16 million units annualized in February up to 17.8 million units in March. And that is going to help overall first quarter GDP a bit. I will say also heavy truck sales, though, fell sharply in February and fell again in March. So again, there's a CEO confidence issue here. There's a business investment spending issue here, which I think is going to become more important next quarter. So a small positive possibly for this quarter. The big thing that's going to also hurt us this quarter is not just the consumer spending is slow in the first quarter, but also we had a big pileup of imports. Now, in theory, those should show up in inventories. But, the way they count up the inventories, the way they count up the imports aren't always in sync. And so I think in the first quarter, we'll see some weakness there. I think in the second quarter, we may see a little bit more of the inventories coming back because they were really actually imported in the first quarter, but they show up in inventory in the second quarter. But then I think you'll see a weakness elsewhere, particularly in capital spending in the second quarter. So overall, we're looking for very close to zero for the first quarter, maybe between 0 and 1% for the second quarter. And then I think unless something else goes wrong, the economy will begin to move up again. Particularly if we come to if today's decision day on tariffs and we don't see further changes in tariffs, if we don't see further changes in immigration policy, if people begin to anticipate some fiscal stimulus, and then you may see a pickup in growth to 1 to 2% in the second half of this year. So I think it's going to be a slow year for GDP growth. But at the moment, this U.S. economy can take a huge licking and keep on ticking. And I think it is still going to do that, just ticking a little bit more slowly. If you move to the next page, page 24 of the guide, we show the unemployment rate and wages. Unemployment rate running at 4.1% right now. I think for the rest of this year, it may stay close to that. It might move up a little bit, but remember, you're going to see this declining labor supply because of immigration coming down. And that, even though you're not going to get, I think payroll job growth will be slow. I don't, right now, I just ran something this morning based on some of the data we have so far and our GDP forecast. I think we'll average about, 120,000 jobs per month is what I'm getting right now. So clearly below what we've seen in recent years, but that might still be enough to hold the unemployment rate constant right now. And I don't expect to see any big spike in wages unless the immigration cutdown gets, or the immigration crackdown gets more significant, because workers are worried, and worried workers don't demand pay increases. So overall, I think the labor market is stable, but seeing less growth than we've seen before. If we turn to the next page on inflation, page 27 of the guide. Okay, so we got down to a 2.8% year-over-year inflation rate. I think the March numbers might even be a little bit better than that, maybe a 2.6 or 2.7% year-over-year inflation rate. I think we'll still see declines in inflation in shelter and in auto insurance. I think that's still going to occur. But I think if you look at core goods, you see the orange area that spiked up there in the middle in 2022, that's all supply chain issues. That's where you're going to see a big spike because of these tariffs. And I think that pushes up, depending on how aggressive these tariff announcements are, I think we will see higher inflation. So right now, I think we'll see something closer to 3 to 3.5% on CPI by the end of this year, and then coming back down to 2 to 2.5% on CPI by the end of next year, if it's just one and done in terms of tariff impacts. But it does delay any improvement in inflation. And then if we move to page 33, the next page, which is page 33 of the guide, where does this leave the Federal Reserve? Well, I think the Federal Reserve they desperately don't want to make a move right now because they just don't know. And Jay Powell has said, that they don't speculate and they don't assume and they don't guess. But he's also said that he thinks that monetary policy is in a good place to sort of wait and see how this plays out. And I think that's what's going to happen. So I think we'll have to see clarity on the tariff issue. And then as a tax bill makes its way through Congress, when we see the true outlines of how much this is going to put in stimulus next year, then the Fed, I think, will make some decisions. My guess is they don't make a decision until June. If the economy is significantly weak, and particularly if the unemployment rate begins to move up, they could cut in June. But equally, they may want to just hold off. If it looks like the economy is going to weather this and pick up a little bit in the second half and be okay next year, and if inflation is going to be higher this year because of tariffs and higher next year because of fiscal stimulus, the Fed does not want to get in a position where they cut rates too much and have to raise them. So right now, I think the Fed is sitting on their hands. And then finally, on the next page in terms of the economy, if you turn to page 30, looking at the dollar has come down significantly so far this year, and that has contributed to an outperformance of international equities, which I know that Gabriela is going to talk about, which is really rather significant. Could the dollar fall some more? I think so. It depends really on how fast the Federal Reserve cuts. But if you have less fiscal stimulus going into 2026, and if you've got more economic weakness, people are going to start building in more Fed rate cuts this year. We know that Japan is going to be raising rates. We know that there's a lot of fiscal stimulus coming down the pike in Europe. And while they will be hurt by tariffs, and again, we'll have to see how much, we've also got the data on their composite PMI indices actually look pretty good. And so if you have less aggressive cuts coming out of the European Central Bank or out of the Bank of England, we've got some increases in rates in Japan. And if the Fed cuts more aggressively, particularly if the US is slowing, then that could bring the dollar down. Also, at some stage, people are going to realize that, diversification means not having all your eggs in one US basket. If capital flows begin to move more around the world, rather than focusing on the United States, that could also bring the dollar down. So I think there is a potential for the dollar to fall. I do want to emphasize that in the long run, economists don't think that other countries are being mean or exploitive in terms of running big trade surpluses with us. For many years, the US dollar has simply been too high, and that is the reason why on the right-hand side, you don't see a single year where we actually ran a trade surplus. It's not that everybody's being mean to us all the time. It's just that our stuff's too expensive, so people don't want to buy it. And their stuff is cheap, so we want to buy it. And I do think that this is a disequilibrium position, which could lead to a lower dollar in the long run. A lot more to say, and I've already talked too long, but I think I'd like to, at this point, stop here and then turn over to my colleague, Gabriela Santos, to talk about investing in this environment.
Thank you, David. Yes, and lots for the markets to unpack already in the first quarter. I think it's been two big themes, somewhat separate, but somewhat related. The first one is all this discussion about policy uncertainty and the impact it could be having on slowing the economy. I don't think markets right now are pricing in a recession in the U.S. if you look at the underlying behavior within equity markets, or if you look at corporate credit spreads. But it's been more pricing in from above trend growth with maybe some upside risk to pricing in maybe some slower, maybe below trend growth with some more downside risk. So I think that's all that's been going on there. And then secondly, a little bit of a cooling in the very sky-high excitement about artificial intelligence and the winners from the extraordinary amount of CapEx that we've been seeing in the space. So particularly hitting things like semiconductors and the whole Magnificent Seven company complex. If we mix those two together and look at the next page, this is page 59 of the guide. This is our periodic table. We can see where the scoreboard was at the end of the first quarter here on the right-hand side. And it's so interesting to see that it's, in a way, flipped on its head from the last couple of years. So we've got U.S. equities in the bottom, large cap down 4%, small cap, which is more, of course, high beta or more sensitive, down 9.5%. But I really think that the conclusion here is that it's been all about the revenge of other asset classes that hadn't done as well. So if we look up top, things like developed market equities as a whole, Europe, Japan up 7%, and emerging market equity up 3%. Just want to call out, especially within those two, Europe, which was up 10%, and China, which was up 15%. If we take it together, that's of the whole international equity space, that's about a 1,100 basis point outperformance, which is the widest since 1989. Incredible. Not just because they were down less, but because they were actually up while the U.S. was down. That's international diversification in action. I also wanted to point out core fixed income, the dark blue. This is really the U.S. ag. Up about 3% as we saw yields come down about 35 basis points along the curve. So also fixed income showing its worth as a diversifier when there are some of these building concerns about slower growth than expected in the U.S. So incredible. Really, the revenge of diversification was the theme for the first quarter. And if we look at the next page, I think it helps to explain why there were such records, such powerful rotations. This is page 66. It was my favorite slide coming into the year, and I think it still is for a bit longer, because it shows really what a strategy a lot of investors could have applied the last couple of years, which was a let it ride strategy. Let's just keep on focusing on what's worked really well. And that became a bigger and bigger share of portfolios. And especially what worked, it was equities, it was US equity specifically in the growth style, and specifically a handful of magnificent companies. So we could see as an example, this is assuming no rebalancing, January 2019, 60-40, half and half split, well diversified. If it hadn't been rebalanced, could have entered this year, not as a 60-40, but a 73-27, so a lot more risk, and could have ended up not as half and half growth value, but 60% tilted on growth. So very unbalanced. And I can see that. I think that's why we've seen such powerful rotation in the market, because the rubber band was really pulled really far, and then it snaps back. And I think there's more room to run here to rebalance portfolios. Just did a quick exercise. How much would a diversified portfolio be down if it had been rebalanced at the January 2019 levels? Year to date, it would have been down about 50 basis points. The let it ride strategy, how portfolios could have been coming into the year, would have instead been down 1%. So it matters. And I think this has a bit further to go. And on the next page, if we start with the fixed income side, this is page 36 of the guide, just worth taking a look at the left-hand side towards the middle where we have returns. Duration, some duration really did have an impact as yields came down 35 basis points on some of these growth slowdown fears. But there was a certain limit there. And I think for us, if there is a desire to diversify, add a little bit of duration, something intermediate duration makes sense. If we go further down and we look at corporate credit, there was a bit of spread widening that happened, nothing alarming, just to levels we had seen in the second half of last year. But because of the coupon, there was a nice cushion there with investment grade up 2.3% and high yield up about 1%. When we think on the right-hand side, just at the risk reward here, if the economy does cool further and then there's actually a pricing of a recession, yields still have some scope to fall here, and then there could be a nice tailwind from duration. They kind of stay range bound where they are, which is kind of what we think. Then there's an interesting coupon or income there just to provide that return through income. And then conversely, if really there's a lot more inflation fear that comes back, there could be an increase in yields. But because of the coupon now, that's actually interesting, there is some cushion there. So good risk reward in fixed income and really showing that it can diversify again. The last thing on the next page to say about fixed income on this page 39 is where in fixed income. I think there had been a bit of a concentration on the two extremes. On the left-hand side, very short duration fixed income, basically cash light. And all the way on the other side, high yielding things like high yield leverage loans, private credit, which still have good yields. But in a slowing economic environment, I think it's important to come even more towards the middle here, which has some of that more core fixed income that gives a bit of duration, still provides interesting income. And that's things like investment grade corporate credit, securitized debt, in that intermediate duration range. On the equity side, on the next page, I just wanted to point out this slide on the left, this graph on the left, because I do think it's been those two stories. It's been policy uncertainty and a slowdown in the economy, and that's really the light blue, the 493 in the market. They're flat on the year. They have not been pricing in a recession. So there's risk there if that does happen. But if not, it just shows that that area of the market, hadn't been overly inflated anyway. But what really has suffered a correction is the green. It's the Magnificent Seven that had done amazing for 2 years and are now down 15%, nearly 20% from their all-time highs late last year. So really, I think another thing that's really played out this year is really that valuations matter, expectations matter, positioning matters, and you're seeing this really powerful unwind. And the last thing to note within the equity market on the bottom right is just not just dispersion between different types of companies, but dispersion within the market between these 7 companies themselves. So it makes a lot more sense when there's more uncertainty, there's more rationalization about valuations and fundamentals. On the next slide, how do we think then about opportunities within the equity market? We revamped this slide a bit. This is slide 10 in the guide, just to talk about a level deeper and having balance, like 50-50 between the growth side, which still has interesting themes around AI, industrialization, healthcare, and the value side. And here on the top right, another way to break down some of the closing dispersion within the market is just earnings growth. And we can see that the gap started to close last year and is expected to continue to improve this year between growth, all right, still doing well, we kind of all know that, and then value playing some catch up after what were 2 tough years. Not because the economy is booming, but just because finally there's a bit of normalization there. So I think that's important, that balance again between the 2 styles, or even just having a core strategy that does both. In terms of room to run on the left, I think this is really important because value outperformed growth in the first quarter by 1,000 basis points. And yet there's still a pretty heavy discount. What was a 40% discount to growth is now 35%. The average is closer to 30%. So still a bit further to go in that important rebalancing. On the next page, similar idea with international. And here is where there's some really interesting dynamics on the right-hand side. We've been seeing a lot of headlines and getting a lot of questions around U.S. exceptionalism. I think you can define that many different ways. I just wanted to point out on the right-hand side that recently there's actually been less U.S. exceptionalism than meets the eye. There's basically been one particularly exceptional company, NVIDIA. If you take that out, NVIDIA was up 200%. It was a 7% weighting. It matters a lot. If you take it out, that's the gray line. And then we compare Europe in green and Japan. They actually did better since late 2022. I think just this outperformance of one company in a particular group of stocks was hiding what was actually improvement overseas. So we can get the question, all right, but was that like 1 or 2 companies in Europe and Japan? And the answer is no. Developed market banks were up 100% since late 2022. That's the end of deflation and negative rates right there. You also had things like industrials, which were up 150% and then got an additional kicker this year with some of the fiscal stimulus that happened in Germany. And we don't want to underestimate that. This is also the end of fiscal austerity in Europe. So quite a big game changer in behavior there, from a country that was known for its austerity, where the word debt is the same as the word guilt, to one that's a country that's doing the biggest fiscal stimulus since the Marshall Plan after World War II. And I mentioned this because of the next page, because ultimately what all this means isn't that all of a sudden Europe is more exceptional than the US or Japan. It's more just about versus expectations. And the left, we can see expectations are incredibly low already. Coming into this year, there was a 40% discount between everything overseas and the US. It started to close because of that tremendous first quarter, but it just went to 34%. And the average is something much closer to 20. This is also true by sector, as we see on the right-hand side on this guide, page 46. So maybe that discount starts to close a bit more with the end of deflation, the end of negative rates, the end of austerity, focus on shareholders, and just a little bit less magic coming from a handful of companies in the US. My last slide is on the next page. This is page 63 of the guide. It's a new one because we've talked a little bit about opportunities in core fixed income, opportunities within US equities, within global equities. But another conversation I think is important to end on is around having many concerns about growth, concerns about inflation, concerns about fiscal, and there's really no magic bullet there to protect a portfolio against everything. So on the left, we see the kind of episodes that bonds can do well, episodes where there is that recession fear, and I think that's still important to have as a diversifier. But on the right, we show that, unfortunately, that didn't really work in 2022 in quite a spectacular flat fashion. And that's because it was much more about inflation and rising rates. What did do well was select types of alternatives. That's the gray. And here, more and more investors getting access to things like real assets, real estate, infrastructure, certain types of hedge funds that can protect in that kind of environment. So an approach where there's an attacker in the portfolio, there's a bunch of different defense players, and that way there's the ability to navigate this policy fog. MP, I'll stop here and turn to questions, please.
Great. Thank you all both very much. And thank you to everyone who's sent in questions so far. David, I'll start with you. Probably one of the top questions we're getting is about the Q1 GDP, where that's headed, and particularly about the Atlanta nowcast, if that you expect that to be accurate.
Well, I think originally the Atlanta Fed nowcast model was saying something like a negative 2.4% on first quarter GDP. I don't think that's likely to occur. And I think they'd admitted themselves that the problem was there was a huge negative number on imports for the first quarter, or just huge surge in imports. Now, some of that was actually gold getting transferred over to the United States, which actually isn't part of the GDP accounts at all. And so that'll get X'd out anyway. But even beyond that, we know that a lot of it was just people trying to import stuff before the tariffs. And that is, in theory, it shows up in inventory, so you should, and that would net it out in terms of real GDP. But if it doesn't show up in inventory, it will tend to drag on the GDP number. So I don't think it's as weak as a big negative number, but I think a much better measure is real consumer spending, which I think will be up by less than 0.5%, maybe 0.2 or 0.3% in annualized in the first quarter, and that does say consumers have pulled back. So overall, it's not that negative. I don't think the economy's in recession right now. There's nothing in the employment data or in the demand data to suggest that, but it definitely, we've seen the economy slip a gear here, and the real question is, can we get a little less uncertainty so the economy can sort of regain its footing going into the second half of the year?
Great, thank you. And a question about tariffs, Gabby. A lot of questions about what other countries are charging the U.S., and we'll hear about that more this afternoon. But.
Thank you, MP. And you and our strategists, also Marina Valentini, have done such amazing work on trade and tariffs, which is available in our policy hub, jpmorgan.com/policy. We've just recently updated a new one to have these more updated conversations. I mentioned this because there's one slide there that shows what the U.S. charges different countries versus what they charge us, and then a line that would be, let's say, a reciprocal line. What's interesting is actually only a few countries stand out at face value as being offsides, charging the U.S. a lot more. And that's your typical protectionist emerging markets: China, Brazil, India, Vietnam. Other countries with which we have trade deals or that have most favored nation, basically zero tariffs, it's kind of already there. I think what will be important this afternoon is the definition of reciprocal, right? This is just tariffs, but the President, Treasury Secretary Bessent, Trade Representative Jamieson Greer have talked about other things like VAT taxes in Europe, like currency manipulation, like wage suppression, subsidies. So it really depends how far the scope is going to be here in this concept of fairness and reciprocity. I think the market would significantly prefer if it was a more narrow interpretation of that. But I think we still have a lot of uncertainty about that.
Yes, and a question about tariffs and the dollar. A lot of people expect tariffs, to create a stronger dollar, but we haven't seen that so far this year.
I think the way I've been thinking about it, and love yours as well, David, is I think Trade War 1.0, that template doesn't really work this time anymore. We thought it would, but that was a scenario where tariffs were targeted. They were specific to China, but they had exemptions. So it was about certain types of goods being imported from China and certain small subsectors. All right, so in that scenario, the U.S. was strong. It's punching a couple of trading partners. It can emerge actually more resilient than others. It's less dependent on trade. But this time around, the U.S. is really doing a much more broad-based, large use of tariffs. In that case, it's picking a fight with basically every single kid on the playground. It's probably going to get hit more, actually, than countries where their exports to the U.S. might be affected, but not necessarily everything else if they start refocusing that. So I think that's been behind some of the weakness in the dollar, about 4% so far this year, is just some rethinking around the strategy and the impact on growth. Plus, as David had gone through, the big decline in interest rate differentials in the first quarter, which was about 50 basis points.
And I think that the other thing I would say about that is it's not just about tariffs. I think the fiscal cutbacks that we're seeing here hitting the economy in 2025, the diminished immigration. I mean, remember, a lot of U.S. long-term economic growth comes from the fact that we've had a growing labor force as opposed to countries like Germany and Japan and China, which have had a shrinking labor force. But if you restrict immigration, that goes away. So I think there are other things which are making people feel more worried about the U.S. economy. And then you've got the just global capital flows. I mean, if people think, well, maybe I've got enough in the U.S. equities as my allocation because it had ballooned so high, those capital flows going the other way, I think, are also helping bring the dollar down. So it's not just about the tariffs, although I agree that a fighting a tariff war with everybody as opposed to fighting a tariff war with one country does put the U.S. at less of an advantage than we saw back in 2019 or 2018.
Yeah, and this concept of capital flows is so important because we were showing that let it ride or portfolio drift slide. That happened to investors around the entire world that were very heavily concentrated on U.S. stocks and in the dollar as a way to kind of reduce volatility, protection during moments of risk aversion. And now we're seeing some rethinking. They're seeing some substantial pain in their portfolios.
Yeah, and I think we need to sort of take a deep breath when it comes to trade also. I mean, yes, we're buying everybody else's stuff and they don't want to buy ours. But on the other hand, they're buying our financial assets and we're not buying theirs. I mean, it does flip both ways. And I think what we're seeing here is you've got to look at the other side, the capital account, not just the current account, when you're trying to figure out what the dollar is going to do.
That's right.
Perfect. And the question we got about labor supply issues perhaps being offset by increased productivity, AI advancements. Is that possible?
I think it is possible. I think it's possible over time. Particularly the combination of AI and robotics, I think, will, over the long haul, help. And I think this is really an important issue for all developed countries, because I think all of these developed countries face the issue of an aging workforce, a declining native-born population. And so if you've got a constraint in labor supply, what are you going to do about it? Well, we do have AI, and that is and robotics, and I think that we can see it being implemented in a lot of places. I think it is a spur to AI investment. So, I used to say back in the 1990s, that productivity is just another word for having no one left to hire. When you've got nobody left to hire, you're trying to find a way of using your existing workers more efficiently. I think that's still the case, but I think it's going to be amplified by the fact that, yes, you could use AI to try and do some of these tasks. And that will, I think it'll spur AI investment. So it's a good thing to regard human labor is precious. So it's a good thing to regard it as scarce and to try and make it as productive as possible. I think we'll see some of that, but probably not enough to sort of change the math on the budget or anything else. We really do need to have a growing labor force if we're going to maintain economic growth, of close to 2% as opposed to falling back to 1.5%.
And do you expect seeing greater wage inflation in the short term due to lower labor supply?
No, I don't. I think that a lot of the areas of labor supply where you're going to have the biggest shortages are workers who really had very little bargaining power in the first place. And I think American business is still very good at controlling wages. If people feel like there are layoffs, if the unemployment rate ticks up a little bit because of federal layoffs, if the economy overall is soft, even if there's a labor supply issue, I think workers are going to be nervous about standing up to their employers and saying, well, give me a raise or I quit. So we haven't seen it. We've seen much tighter labor markets over the last few years than we have today. You saw the job openings numbers came down on Tuesday. So I don't think we'll see significant wage inflation out of this. I think I'm more worried about, people always talk about stagflation. I worry about inflation stag. I worry you get the inflation in the short term, but the longer term you get slower growth.
Perfect, thank you. And Gabby, we got a really interesting question talking about how the pullback of globalization, could this cause the correlation between U.S. and international assets to actually decrease?
I think there's a really interesting question behind some of the conversation we're having about capital flows. So before there used to be a negative correlation between the dollar and the S&P 500, meaning the dollar strengthens during moments when equities are falling, there's risk aversion because there's a certain flight to safety. We didn't see that. Actually, we saw both move lower by almost the same amount in the first quarter. So I think just thinking about a foreign investor that had a portfolio set up a certain way in U.S. equities, unhedged, trusting that it would do return and volatility dampening, all of a sudden is thinking, hold on, maybe that's not exactly the case. And that's why you are seeing some rebalancing, which could still have legs for international investors to do a bit more of that rebalancing. Now, it's too early to tell. It's been one quarter exactly what the behavior of the dollar is going to be in different moments in time. I think if it really came to pricing in a significant U.S. recession beyond just a slowdown, maybe the dollar starts behaving a bit more like a safe haven again. But I think it depends, right? At the moment, if it's just a slowdown, it seems to be behaving differently than it normally is.
Yeah, and I think you will continue to get some diversification benefits from international. I think that will still be there. I would probably underplay the idea that there's going to be a complete disconnect. One of the things I see happening is, I don't know if people in the United States are quite aware of how much the rest of the world is on tenterhooks about this tariff increase. I mean, I read the Irish Times every morning. They've got the time of the president's speech in Irish time. So they're all up at 9 p.m. this evening trying to figure out what are they going to do to Ireland. But that's true around the world. Though the U.S. dominates people's thinking around the world about the global economy in a way that people in the United States don't think about Europe as much. Now, I think that's important because all this negative news, which is not necessarily seen as entirely negative in the United States, but it is seen as negative around the world, and that is causing people to be more cautious around the world. And that may sort of keep those correlations a little bit higher. That if maybe Europe shouldn't get hurt as much by U.S. policies as the U.S. does, but maybe that's not the way the Europeans see it. And so yes, I think international is an important plank of diversification, but one of the things we've been talking about for some time now, but we re-emphasized in the first quarter also, is have alternative assets in a portfolio, things like infrastructure, real estate, transportation, private equity. Have these things in a portfolio to try to add further diversification, because international diversification, although we're very much in favor of it, probably isn't enough for the moment that we're in.
Mm-hmm.
And David, you talked about potential fiscal stimulus in 2026. What type of fiscal stimulus do you think would be most likely?
Well, I think there are two parts of this. One is what's in the president's agenda, and the sort of agenda of Republicans in Congress, and then two, what's necessary or what was most useful at goosing up the economy ahead of the 2026 elections. So one of the things the president made clear is that he wanted to cut corporate income taxes on domestic production, and there will be a lot of people who will be speaking in his ear. They'll have direct impact on that decision. So I really expect that corporate tax cut will be part of this stimulus. I think it'll be the first thing that they make sure is in that bill, along with, and he even mentioned this in his address to Congress. One of the very few specifics in that address was that he specifically said that the exemption or the expensing, 100% expensing of R&D and equipment purchases for domestic production will be backdated to January 20th of this year, which I thought was really interesting. He was very, very specific about that. I think that is really something very high on their agenda. I think other things, I don't expect to see much on taxing of tips, because I think it's just so complicated. I think he'll say, well, I tried to get stuff on Social Security, but I didn't get that much. Or I tried to get stuff on overtime, but I couldn't get that much, just couldn't afford it. So I think I would sort of fade that a little bit, but I would also think carefully about the Doge dividend or Dodge dividend. I think that could be used. There's nothing that stimulates the economy more than a stimulus check. And the thing about those dividends is if they're, as was proposed, if it's one, a check, whether it's $1,000 or $2,000 per household, if it's the same amount for every household that pays taxes, which is how it was proposed, you've got like 80 million tax-paying households in the United States or income tax-paying households. If it's the same amount for each one of them, then it is a very or egalitarian tax cut. It means that a lot of people who live paycheck to paycheck get another paycheck, they'll spend it. That's exactly what gave us such a surge in both economic growth and inflation coming out of the pandemic. So my guess is the weaker the economy is, the more likely we're going to get some piece of sugar like that in this bill, and but it will make all the difference, because if it's just about marginal tax rates, and particularly corporate tax rates, it won't stimulate the economy. But if it's about giving checks to lower middle income households, or possibly cutting income taxes on Social Security and on overtime, then I think it does offer, result in fiscal stimulus. Again, the thing to watch here, forget about what they're saying about cutbacks and reductions in government spending. What is the projection for the deficit for fiscal 2026 and 2027? We're right now at about 6%. If that goes up to about 7% of GDP or 7.5% of GDP in 26, 27, that's fiscal stimulus. If it comes down to 5, that's fiscal restraint. I'm betting on stimulus.
Thank you. And I think we have time for one more question here. Question about the Treasury market. Do we see any risk to the Treasury market and potentially other partners, not buying U.S. Treasuries?
I think what we had been seeing really since late 2022 was that marginal buyer of treasuries was no longer that foreign investor, because there were two slightly different things happening. The first is that end of deflation, that end of negative interest rates in Europe and Japan, which means basically if you're an insurance company or a pension fund in these markets, you don't have to either take currency risk by buying treasuries or pay a hedging cost to buy treasuries without the currency impact. You've got decent yields at home. I mean, at this point, German bonds are almost at 3%. So I think that was one. There wasn't a mass selling of treasuries. It's just that the marginal buyer that used to be there in droves from foreign investors just wasn't there anymore. The second factor that's been happening really since 2022 as well, after the invasion of Russia and Ukraine, was the diversification by China and certain other central banks to diversify their holdings. And that's been a steady move lower in their holdings of U.S. Treasuries and their purchases of gold. You can really see that. It wasn't necessarily aggressive selling of treasuries. We didn't see that impact, but it was a slow trickle as it got marked to market, as it started expiring. China and other EM central banks weren't there either as the buyer. So I think that's what was behind some of the drift higher in U.S. yields, because it just had to be absorbed more here, right, by our own investors domestically. Now going forward, I don't think any of those dynamics change. When we were talking about capital flows and this idea of foreign investors, I don't think that this is a story about them at the moment completely revisiting their ownership of U.S. assets at all in general, including treasuries as an important diversifier and safe haven and liquidity provider, but just more a slow rebalancing towards other parts of the market. So right now, we don't see a chaotic situation that would have a very negative impact in the treasury market, but it is a dynamic that's been taking place for a while, and that puts a certain floor on treasuries as that needs to be absorbed here.
But I think the one last point I'll make about it is it's a very double-edged sword for other international central banks, international governments, in that they could say, well, we're going to retaliate for what you've done to us on tariffs today by cutting back our holdings of treasuries, because if you do that and you cause the dollar to fall, then that's only going to make it even harder for your exporters who are already suffering from these tariffs. So it's very much a double-edged sword. And, in a way, that's that's sort of the point, isn't it? That free trade, a lot of trade is good for everybody. Less trade is bad for everybody, and it's very hard in a trade war to hurt your opponent without hurting yourself too. I've always thought that tariffs are a bit like a strike. I mean, you can threaten strikes, you can even go out and strike for a while, but you shouldn't plan for permanent strike. And I sort of feel the same way about tariffs. We hope that the end game here is one in which we have fairer trade, perhaps, a more reasonable dollar, certainly, but also in the long run, lower tariffs and not the higher tariffs that we're probably going to end up with at the end of the day.
Yes, definitely. We're going to watch what happens later today. And thank you, David, and thank you, Gabriella, and thank you to everyone who tuned in today.